Treasurer Joe Hockey has handed down his first budget for the Abbott coalition government. One of the key priorities for this year's budget was to get the budget back into balance and put it on a more sustainable path. The budget is not in crisis. Australia has a AAA credit rating, and that was likely to remain intact even with no tightening. Further, Australia's net debt levels are well below the average of the OECD, even with no tightening. But Australia does have a structural fiscal problem because the population is ageing, which means government spending will rise over time and its tax revenues will be eroded over time also. So some tightening was warranted in this year's budget to avoid ever larger deficits in the future and to avoid ever larger and growing debt in the future. The government now expects that the budget will be back in surplus by the end of the decade. The road to surplus is a difficult one. Indeed, the tightening in this year's budget was made up of $12 billion worth of spending cuts and $5 billion worth of revenue initiatives over the next 4 years. The better news for the management of the economy is that much of this tightening is backloaded. Over the next 2 years, much of the tightening is modest, and much of the tightening will take place in 2016 to 17 and 2018 to 19. By that time, the economy should be on a stronger growth path and more able to cope with the stronger tightening measures. The key challenge for the economy, of course, at the moment is that it's transitioning away from one that is being driven by mining investment because mining investment is slowing. So it's not the appropriate time for the big nasties of the budget to occur in the near term. The biggest spending items for the government are welfare, education and health. So not surprisingly, those areas were targeted in this year's budget. No household escaped any of the savings measures, but low-income households were hardest hit, particularly the youth and the unemployed. What are some of these household measures? The co-payment for a visit to the doctor of $7, the extra $5 that a patient will pay for PBS listed medicines. There is the petrol excise that will be lifted, and also the reintroduction of indexation for petrol prices twice a year. There are the tighter eligibility and thresholds for a range of welfare programs. It also includes the deregulation of the university fees and a 2% levy on households that earn $180,000 or more. Companies are not directly affected by the cuts introduced to welfare programs, family payments, and the public service, but they are still affected by them. Their ability to earn money, invest, expand, and hire new employees is dependent on sales, and sales growth is tied to demand. So less money in consumer pockets could mean that this would flow through to consumer sentiment and consumer spending, which, if significant enough, could temper the economic recovery that is currently underway. If this scenario came to fruition, then we would expect that the Reserve Bank might start raising rates later. So that is, we would expect that they might start raising in early 2015 rather than later this year. The big headline act for businesses this year was the cut to the company tax rate from 30% to 28.5%, effective from 1 July next year. That will help businesses be more competitive in Australia, so that is quite an attractive decision for the business environment. Small business escaped with less pain than families and big business. Small business will benefit from the company tax rate that I talked about, but small businesses also had a range of other initiatives that include the Entrepreneurs Infrastructure Program. It also includes the Industry Skills Fund. There are also subsidies to be paid to small businesses for hiring workers aged over 50 years old. Of course, some businesses in the SME sector will benefit more than others. So what's one of the challenges for this year's budget? Well, I would have to say that one of the key challenges is actually getting these proposals through Senate. That's because the composition of the Senate will change from 1 July. Also in this year's budget, the federal government pushed more of the funding for health and education onto the states. That may cause the states to pressure the federal government to widen and lift the GST. What that will mean is that in coming days and in coming months, there will be interesting times for federal-state relations and interesting times in the Senate.